The Federal Reserve may soon have to give Donald Trump bad news. Trump wants lower interest rates, but Kevin Warsh, the new Fed chairman, is entering a difficult moment. The economy is strong, inflation is rising again, and the case for rate cuts has weakened. So instead of cutting rates, the Fed may need to keep them high or even raise them. When Trump appointed Kevin Warsh in January, rate cut seemed possible. Inflation was cooling and the job market looked weaker. But by June, the picture had changed. The labor market became stronger with payrolls rising by around 188,000 jobs per month from March to May. Unemployment stayed low at 4.3%. The economy also looked strong, with GDP growth estimated at around 3.3% annualized. So Walsh was chosen when cuts looked plausible, but now the economy is arguing against them. Inflation is the biggest problem. Higher oil prices caused by the Iran war have pushed inflation up again. Annual inflation reached 4.2% in May, a 3-year high. Normally, central bank can ignore a short oil shock, but this time is different because inflation has been above the Fed's 2% target for years. If people start expecting inflation to stay high, it becomes harder to control. That is why Fed cannot easily cut rates now. Walsh had argued that artificial intelligence could help lower inflation. The idea was that AI would make companies more productive, reduce cost, and allow the Fed to cut interest rate. But so far, the opposite has happened. AI excitement has boosted stock market, increased data center investment, and supported strong demand. In economic theory, faster productivity growth can actually require higher interest rates, not lower ones. So AI is not giving Walsh an easy escape. Walsh also suggested shrinking the Fed's bonds holdings while cutting the interest rates. This is called quantitative tightening or QT. The idea was that shrinking the balance sheet would tighten the policy, giving the Fed room to cut rates. But the effect is likely to be small. Shrinking the balance sheet by about 5% of GDP may be equal to only around one small rate rise. It also sent confusing signals to the market, tightening with one tool while easing with another. So, quantitative tightening cannot magically justify rate cuts in a hot economy. The final message is uncomfortable. Trump wants lower rates, but Fed's job is to fight inflation. Right now, inflation is still too high, the labor market is strong, and the growth remains resilient. Wash may be able to delay by focusing on Fed reforms. But if the rates move later this year, they are more likely to go up than down. So at some point, Kevin Warsh may have to tell Trump the answer he does not want to hear. No rate cuts soon.